The new financial year started a couple of days ago, and your very next pay is already different. Most people won't notice for months. A whole set of tax and super rules changed on the 1st of July. Some of them quietly put money back in your pocket. One or two of them can cost you if you don't check a single number. By the end of this video, you'll know exactly what changed, and the 3 moves that start your year ahead instead of behind. Almost all of it you can do from your phone tonight. This isn't about last year's tax return. That window closed on the 30th of June, and nothing you do now can change it. This is about the year that just began, while the whole thing is still in front of you, and it's all Australian. Real brackets, real super, none of the imported American rules that get thrown around online and don't actually apply here. Here is the change that touches every single person who earns a wage. From the 1st of July, the tax rate on the first slice of your income, the part between $18,000 and $45,000, dropped from 16% to 15%. On its own, that's worth up to around $268 a year. Not life-changing, but it's the first thing you'll see on that 1st July payslip, and it's the start of a bigger shift, because that same rate is set to fall again to 14% next year. So let me walk you through everything that changed and then give you 3 moves to lock it in. And keep one thing in mind as we go. One of these changes looks like the government simply handing you more room. For most people, it is. But if you're already putting extra into your super, that very same change can quietly tip you over a limit and cost you money. I'll flag it when we get there. The second change is the one that makes tax time simpler than it has ever been. There's now an instant $1,000 tax deduction for work expenses, and you don't need a single receipt to claim it. If your work costs are usually small, a bit of phone use, some stationery, a subscription or two, you can now just claim the flat $1,000 and move on. The government expects around 6 million workers to use it, for an average saving of about $200 each. And it doesn't take anything away. If your real work expenses come to more than $1,000, you can still claim the full amount the old way, with your receipts. And things like charity donations, union fees, and income protection insurance still sit on top. It's simply an easier floor for people who don't have big claims. The third change is in super, and this is the one I told you to keep an eye on. The amount you're allowed to put into super at the low tax rate, the concessional cap, went up from $30,000 to $32,500. The after-tax cap went up too, from $120,000 to $130,000. More room, taxed at just 15%, is genuinely good news. But here is the catch, and it's the one almost nobody checks. That cap includes what your employer pays in, which is 12% of your wage this year. If your pay went up, their 12% went up with it. So if you've had a set salary sacrifice amount running since last year, your employer's share plus your own can now quietly push you past the cap. And every dollar over the line gets taxed at your full wage rate instead of 15%. The extra room can bite if you don't recalculate. We'll fix that in a minute. There's a second super change worth knowing. From the 1st of July, your employer has to pay your super at the same time as your wages, within a few days of payday, instead of once every 3 months. It's called Payday Super. It means your money starts working sooner, and it means a missing payment shows up on your very next pay slip, not a quarter later. The next 2 changes are the ones you won't feel on payday at all, which is exactly why they're the ones that catch people out. If you have a HECS or help debt, the way you repay it changed, and it changed in your favor. The old system took a flat percentage of your whole income the moment you crossed a threshold, so earning $1 more could cost you hundreds. Now it works like the tax brackets. It's marginal, which means you only pay on the income above the line. For this year, that line sits at around $69,500, and you pay a small share of whatever you earn above it. And if you haven't looked at your balance in a while, look again. A one-off 20% cut was applied to every student loan last year. A $30,000 debt became $24,000 automatically. A lot of people still don't realize it happened. The fifth change is a quiet one that decides whether some people pay an extra tax at all. The income thresholds for the Medicare levy surcharge went uppy. For singles, it's now $105,000. For families, $210,000. If you earn above those and you don't hold private hospital cover, you're charged an extra 1 to 1.5% of your income, on top of your normal tax. because the threshold moved up. Some people who sat just over it last year now sit just under and pay nothing. If you're anywhere near that line, it's worth knowing exactly which side of it you're on, because that surcharge can quietly cost you more than a basic hospital policy would have. And here is one that hasn't started yet, but you should have on your radar. From the 1st of July 2027, the rules on negative gearing and capital gains tax for investment properties are set to change. Anything you already own is protected, but if you're thinking about buying an investment property, the tax treatment a year from now won't be the one you've read about for the last decade. If that's you, this is the year to get proper advice, not the week before it starts. I made another video going deeper into how the negative gearing and capital gains tax changes will affect your investment strategy with easy to understand examples. I've linked the video in the description. So that's what changed. A tax cut on your first bracket, a $1,000 no receipt deduction, more room in super, but a cap that's easier to breach, a fairer HECS system, and a 20% cut already applied, higher Medicare surcharge thresholds, and property changes on the way. Now here's what I would actually do this week. Move 1, open your 1st July payslip and check 2 things. First, that your taxes come down. Second, that your super is actually on there, because from now on it should appear every pay. If it's missing, you've caught it in days instead of months, and you can raise it straight away. Move 2, and this is the one that matters most. Reset your super, log into your super funds app, not MyGov, but your actual fund, whether that's Australian Super, Host Plus, Rest, or wherever your money sits. Look at what your employer's 12% adds up to across the year, then set your own extra contributions to fill the gap up to $32,500 without going over. 10 minutes now protects you from a tax bill later. This is the catch I flagged earlier, and this is exactly how you close it. Move 3. Decide how you'll handle deductions for the year today, not next June. If your work costs are small, you can relax. The flat $1,000 is there whenever you lodge. If your costs are bigger, start now. And this part is genuinely easier than it used to be, because AI has made tracking almost effortless, and none of it needs to cost you anything. Open a note on your phone, or ask a free AI assistant like ChatGPT to set one up for you, and just tell it you're working from home hours each week. For receipts, the ATO's own My Deductions tool sits free inside the ATO app and lets you photograph each one the moment you get it, so everything is sorted and totaled automatically by tax time. The choice between the flat amount and the bigger claim is yours in 12 months, but only if you've kept the records to back it up. So that's your year, set up properly. You've just done the work to keep more of what you earn. But here is the question that actually matters, and the one number I've deliberately left out. Keeping more of your pay is only ever step 1. The real question is how big all of this has to grow before it can pay your bills for you, before the money simply shows up in your account every few months, whether you go to work that day or not. I worked out that exact number for Australians, the amount you need invested to retire on the income alone, for a modest life, a comfortable one, and the full version with nothing off the table. If you're closer to the end of your working life than the start, that is the video to watch before you do anything else. It's right here, and I'll see you over there.